Hello YouTube, it's Victor from TRADEPRO Academy, and today, as you can see, we're at the YouTube studio, so we're at a different setting. And today I'm going to be talking to you guys about dividend stocks, dividend yields, and dividend portfolios. So let's go ahead and get started with today's lesson. So today we're going to be talking to you about dividends. So what is a dividend? A dividend is a lump sum paid to shareholders depending on the number of shares they have. Now, dividends can be paid quarterly or even annually, and they're based on the profits a company may have. So if a company has leftover profits, they could decide to pay dividends. Now, there are some companies who frequently pay dividends, and they've been paying dividends for years, and we're going to talk about those companies today. So there are added bonuses in companies that do pay dividends and stocks that do pay dividends. Number one, if you live here in Canada like us, you get a tax credit based on dividends received from stocks. So that tax credit reduces that tax payable, which is amazing. In the States, there are different levels of taxable income depending on dividends. So I believe it is an income of $38,600 where you do not have to pay tax on dividends. Between that number and about $400,000, the dividend tax rate is only 15%, so that's not that bad. Another added bonus is if you do have dividend paying stocks in your portfolio, no matter the fluctuation of the stock, if they pay consistent dividends, you will get a consistent income quarterly or even annually. So that means if the stock manages to drop a little, you'll still get those dividends. If the stock just stays sideways again in that portfolio, you will collect dividends. But that is only a good thing if the company continues to pay dividends and has continued to pay dividends in the past. So next up, what to look for in those dividend paying stocks, how to zero in on a good dividend paying stocks. We have a few criteria up here on the board before we do get into our example. So first, does the company pay dividends? That's a number one self-explanatory rule. You're going to look for companies that do pay dividends. And of course, you're going to be looking for companies who've historically paid dividends for a while with little volatility in the dividend. So that means if they decide to pay 1% dividend the first year and then 7% the next year, then back to 2%, the volatility in paying dividends isn't that great. And there's a little more uncertainty with those companies in terms of profit and earnings accumulated to pay out those dividends. So what we're looking for is consistency. We're looking for stocks that pay dividends year after year at consistent levels. Even if they don't change that much, that's still okay as long as they do it consistently, or if they do grow bit by bit each year, that's even better. That means the company's earning a lot of money and can afford to pay out that extra dividend. Now let's talk about the yield and the earnings per share. So we're looking for dividends that, of course, pay higher yields and are less volatile. So we'd consider a dividend around 3% annually, pretty good dividend. So assuming a company does pay that 3% and you have $100,000 invested in that company, you're getting $3,000 a year extra of dividend income. So dividends, of course, generate passive income, which is amazing. Anything above that is just icing on the cake, but there are a lot of stocks that do pay 5, 6, 7% dividends annually. And of course, make sure those stocks are not volatile in their dividend distribution. Now, earnings per share. We talked about it a little before, but now what does that mean in relation to the yield? So you're looking at the earnings per share of a company because you want them to be able to pay that dividend. So that's where the dividend does come from. You want the earnings for the company to grow year after year and them to have a positive earnings per share so they can pay the dividend out. So for example, if we've got an earnings per share of $3.7 and they manage to pay out $3 each year in dividends, that leaves 70 cents. So the difference between $3.70 and the $3 they do actually pay is a possibility for the dividend to increase year after year, assuming earnings stay stagnant. So they have the possibility to increase their dividend by the 70 cents that we talked about, even if earnings per share don't continue to grow. Alternatively, if earnings do grow and the earnings per share and dividend paid out, that spread increases, they've got more money to pay more dividends. So assuming that $3.7 of earnings per share turns into $5, then you've got $2 extra per share to pay out dividends, and that's when companies start to increase their dividends. When they're doing well, they keep shareholders happy, they keep everyone happy. So enough of the explanations, let's get down to an example here. All right, trade pros, so we're doing an example now. MO, Altria, tobacco company. Now they are known to pay dividends. Historically, they've been paying dividends. There's been some fluctuations, but that does depend again on earnings per share. The fluctuations haven't been crazy, and they've steadily increased their earnings per share and dividends paid. So they've got a 5.5% yield and have paid $3. So they paid $3 per share on their dividends, and their earnings per share is $3.69. So remember, it was similar to the example before, in which they do have 69 cents left over to pay higher dividends. So they've been increasing their dividends quarter after quarter about by 10 cents, and they do have the capacity, as you can see. So these are companies you want to look for that do pay higher dividends and consistent dividends. So this was one of many examples, and guys, when you're looking for dividend stocks, do consider the things I've talked about today. There are other stocks that do fall into those categories, and generally dividend-paying stocks that pay consistent dividends are of lower beta, which will work well in diversifying your portfolio. So Procter & Gamble, they're a very consistent dividend payer, and their beta is lower. There are lower fluctuations because Procter & Gamble does create a lot of consumer products and a lot of necessities. So again, when looking for dividend yielding stocks, do consider those, consider the value companies as well, and consider a dividend yield of about 3 to 5% to get some good bang for your buck. Again, this was Victoria from TRADEPRO Academy. I hope you guys enjoyed this quick little lessons on dividend stocks at the YouTube studio, and join us next time for some more fun videos. Take care, everyone. Hit that subscribe button, drop a like, and we'll see you in our live trading room each morning, Monday through Friday.